My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make a little money. My job, not just entertain, but how about context? How about understanding? Call me, 1-800-743-CNBC. Tweet me at Jim Cramer. We're at that darn fulcrum moment when bad news is good news, but it's still bad. We want to hear about layoffs because it means the Fed can ease up. But we don't want to get laid off ourselves. Welcome to the living hell that is a true Fed tightening cycle. It plays out every day, including this one, the day before a Fed meeting where we find out what's really going wrong. Dow dipping 80 points, S&P declining 0.41%, NASDAQ tumbling 0.89%. Let me give you some examples. All right, this morning, Cramer fave Intuit announced a hiring freeze at its Credit Karma business because lending has slowed down, so people aren't checking their credit scores around the clock anymore. Credit Karma's the jack of all credit. They can get you pre-approval for loans, they can help you identify credit card fraud, and they show you how to get a better credit rating. But when the Fed's raising interest rates, nobody wants to borrow money aggressively because they're too afraid of losing their job, and the cost of borrowing, it's skyrocketed. Got a mortgage last year, you might have locked in, say, 3% and change. Now you can't even lock in 7 and change, and it could get even worse after tomorrow's Fed meeting. We've already had a fistful of rate hikes, and we're preparing ourselves for a few more. Which brings me back to the bad karma that Credit Karma racked up, which is why the parent company at one point lost 7.6% of its value in the morning. This acquisition looked brilliant when Intuit paid $7.1 billion for it back in 2020. At one point, it was among their fastest-growing units. Now it's suddenly the go-to the game, and you know I do not mean greatest of all time. Now, I'm not trying to pick on Intuit. Far from it. They make the best small business software in the game. You can't operate without QuickBooks and TurboTax. And even after seeing its stock go down so much in the morning, guess what? Credit Karma didn't hurt the company at all. It came out after the close and reiterated its guidance for the quarter and the year. The stock reclaimed the whole loss. But you know what? Trust me, as we go forward from here, there won't be many comebacks from the blow-ups. You see, once again, like other times when we are fighting inflation and recession at once, this is a very different market. When there was lots of free money sloshing around, you wanted to know how much free money you could get. That spigot's now closed. So why bother to figure out how much you can't get? In other words, this market's become what I call a living minefield. You can't take a step for fear that you might land on the next Intuit after its blow up in the morning, because there may not be an afternoon revival. Believe me, when the Fed tightens again tomorrow, there'll begin to be landmines galore. So how do you avoid the landmines? Well, in the old days, it was pretty easy. You could circle the wagons around FAANG, plus Microsoft, because they were all great secular growth stories that could buck any tightening cycle. That's how great they were doing. Unfortunately, that's no longer the case. These days, we have enough smartphones. The cloud is just old hat. Online advertising business is falling apart. Personal computers are in such low demand that you might as well, I don't know, how about we use them as bookends? How about that? I mean, how many PCs do you need? I have one. They almost feel like they're the phone books of the current era. Now, if you don't know what a phone book is, you can just always either Google it or ask your mom or dad. Facebook isn't even Facebook anymore. It's not even Instagram anymore. It's not even Reels anymore. It's Metaverse. You know what Metaverse feels like to me? Bluth. Don't buy, don't buy, don't buy, don't buy. But they aren't alone. For years, that's a reference to an old TV show that I was in. For years, we figured that enterprise software would never slow down either, right? Enterprise software didn't eat the world. Turns out it was just the Fed's easy money policies allowing endless tech startups to get funded. Software now needs Pepto-Bismol. Do we have any Pepto-Bismol? I always like to chug it. That's what enterprise software is doing right now. Chug, glug, glug, glug. Not bad. Oh, well, how bad is it? You know how I said Intuit turned out to be a landmine when you least expected it? You know, a little more than a decade ago, I took a trip. I went to the Golan Heights. That's that border between Israel and Syria. When you get there, it's a little daunting, frankly. You see a sign every few feet with a skull and crossbones and the word mine. To me, enterprise software now seems like it resides on the wrong side of the Golan Heights. These companies all feel like they do the exact same thing, using cloud-based software to improve performance or get more customers or analyze more data while keeping it safe for cyber thieves, yet be instantly retrievable and code-free. Sometimes I wonder if they'll stay on the wrong side of the Golan until they all merge. The one good thing I can say about cloud software names is that they're not semiconductor stocks. Chips seem to be in glut everywhere. I thought some were so good that they couldn't be stopped, but that was naive. Turns out the best chips were so good that they got banned from selling them in China, the best growth market in the world. 2 steps into that Syrian minefield, and then you're on Intel. I did think AMD had some good things to say this evening, but we need to know more before we see if it's demined. Gaming, daytime precision bombing. Chemicals and paper stocks, nighttime saturation bombing. And even they still have the edge on SPACs. The SPACs of the world, they aren't mines. They're being carpet bombed around the clock, craters everywhere. If you want to avoid a minefield, you have to go to the new leaders of this market. Leaders like healthcare, leaders like the oils, leaders like the financials that lay off people's amount of course, and their stocks go higher, not lower. You buy the industrials that are levered to travel. You buy consumer packaged goods stocks that have lots of commodity costs that are now coming down. It's why I keep suggesting you look at what we're doing at the Investing Club, the CNBC Investing Club. For instance, here's a good one. Hey, do you like beer? Free beer. I had free beer once at the bar. People like free beer. We like the stock of Constellation Brands. Why? Well, that's the maker of Corona, Modelo, Pacifico. Oh, by the way, the Gen Z, XM, whatever, they love the brown bottle so much you can charge them anything. But my work shows that when you go into a recession, beer consumption actually rises. At the same time, raw costs like aluminum and glass, they go lower. Well, that's my kind of stock for this moment. STZ. How about LLY, Eli Lilly, which is on tonight and has a boatload of new drugs, including a terrific one for diabetes and even better for obesity. Could be among the greatest sellers. No, I think it'll be among the top 5 sellers of all time. A drug that could make you lose 25 pounds without. Don't we all want to lose it? Anyway, it's why I keep kicking myself about missing PepsiCo, because you don't need a weatherman to know when the headwinds of commodity costs become the tailwinds for margin improvement. Mondelez, Kraft, Kellogg, Colgate, Procter & Gamble, they all work. When it comes to the supermarket, only General Mills has run too far. Now, look, I know that we're seeing high-profile tech stocks come down to levels where historically they'd be very interesting. I like the low-price earnings ratio of Alphabet. I can make a case for it. Same goes for ServiceNow. Just had a remarkable quarter. But nobody walks into a minefield on purpose. It's bad enough hitting a mine like Intuit when you thought you were in a safety zone. How can you willingly take the risk in tech? Much better to own stock in a neighborhood where the mines have been cleared, like the banks. Here's the real rub. I want you to think about Johnson & Johnson for a moment, not the baby powder. Here's a company with a AAA balance sheet that just bought one of the most important cardiological device makers, and that's Abiomed, and for a great deal of money. And it didn't matter to the stock because J&J has so much cash that it didn't ding the balance sheet. Even better, they're breaking up into the consumer packaged goods companies, which I want, and a faster-growing medical company with Abiomed and pharma devices and pharma and drugs, which I crave. The brothers Johnson, they've got karma, real good karma. No need for credit karma. You got Johnson karma. Here's the bottom line. As we get into the more of the Fed's tightening cycle, we have to be thinking, I can't step here, I can't step there. So just go the other way. Even better, maybe stay out of the Golan altogether. Never know when you might make a wrong turn. Jack in New Jersey. Jack!
Hey, what's going on, Jim?
Jack, I don't know. I'm trying to get my arms around this market. You know, it's not easy.
I hear you. Hey, Jim, Ulta Beauty looks like they survived the pandemic with flying colors. They added curb and store pickup. They improved their online ordering, and they added a rewards program. But do people know that they just added hair salon services, and how much can that add to the bottom line?
No, they've known they had it for a long time. You know, I actually walked out of the light because I was starting to think I didn't have enough makeup on. I might look better in the dark. Ulta is terrific here. I like the new CEO. I like the way the stores look. I like the price points. And I've got to tell you, Ulta has room for literally hundreds of more stores. Hundreds. I want you to remember the brothers Johnson and stay out of the Golan. You never know when you might make a wrong turn. Oh, man, tonight. Well, we've got some pretty special things. We've got, travel trust name Eli Lilly, which you can't beat. They reported a better than expected quarter, but people sold off anyway. Why? Well, I guess there's just no accounting for wrong. I'm starting to talk. You know what else I'm talking to? I'm talking to the CEO of Kroger. They're acquiring Albertsons, doing a $25 billion deal, digging into the details with the top brass. And then a quizzical one, Airbnb. After the bell, people are selling it. Are they right to do so? Why don't we break down the numbers and find out? So I suggest that you stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.